Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. Well, in this installment, I'm going to talk about one particular strategy to deal with market volatility. And the reality is we need to plan for uncertainty in our portfolios in advance of the uncertainty happening. We live in a very chaotic world from time to time. Volatility is part of being an investor. Most of the time the markets are up, but from time to time they're down. So I'm going to talk about a strategy that you need to build into your portfolio to be successful over time as a retirement income planning investor. Now, if you're new to our channel, make sure you hit the subscribe button so you don't miss future content on various aspects of retirement income planning and overall wealth planning. If you go to the show notes, you can find out how you can get a complimentary retirement income planning forecast, as well as complimentary free educational resources in the area of retirement income planning. Okay, let's take a look at these strategies, this one particular strategy that I think you need to make use of. So this strategy really hinges on the idea that you need to be clear on your cash flow requirements when you go into retirement. Obviously, you've worked on your budget, you've done some planning, you know what level of after-tax income that you need to generate to fund your lifestyle. And so once you have that number, then our recommendation is to set aside at least 3 years worth of that income need in your portfolio as safe harbor reserve assets. The image you see in front of you on the screen right now, I've got it broken down in this timeline. So timeline 1 is cash or cash equivalent investments. Timeline 2 is income or balance portfolios. And timeline 3 would be pure growth portfolios. We've talked about this before. So in that first timeline, that's your 3 years worth of income needs. And you want to have those set aside in GICs, money market accounts, high yield savings, very conservative investments that are not going to go down in value. Once you stretch the timeline out 4, 5, 6 years, you can move into more balanced kind of investment accounts. Again, you're going to get a little bit more growth over time, but really you're trying to manage short-term volatility as well. And once you get out to 8, 9, 10 years, you can focus more on growth investments. Time is the investor's best friend when it comes to market volatility. So one of the ways that you deal with market volatility, like I said at the beginning of this video, is to deal with it in advance of it happening. Do your financial plan, your retirement income plan. Confirm what your budget is. Confirm how much money you're going to need to take from your portfolio over the next 1, 2, 3 years. Set that aside in this cash equivalent component to your portfolio. That's the first step, very, very critical. The way you want to look at it, we call it the income wedge. Over the overall circle here is your portfolio. The wedge is in the red. That wedge is going to generate, in this example, $25,000 per year over a 3-year period of supplement other government pensions or pension sources that you might have. So that's the idea. Number 1, do your plan. Number 2, confirm what your cash flow needs are going to be. Number 3, set aside those cash flow needs over the next 3 years worth of needs and safe harbor very conservative assets. And if you do that, you'll be able to weather market uncertainty. I hope that you found the video helpful. Again, if you are not subscribing to the channel, make sure you do that so you don't miss future content. If you want to find out how you can get a complimentary retirement income plan, go to the show notes. You can find the link back to our website to get more details on that, as well as getting information on our free courses on retirement income planning. Anyway, wishing you all the best in your retirement and overall wealth planning journey. You take care. Bye-bye.